Good evening, ladies and gentlemen. This is Frank Black, the FedWatcher, and we have a special program this evening. I wouldn't call it an emergency. I'm not running around with my hair on fire, but I think this is very noteworthy. I want to say that as of today, I am completely out of the stock market. I have no positions. I do not intend to get into the stock market on any dips. I do firmly believe that we are in for an extended bear market, and I'm talking on the time frame of anywhere from 5 to 10 years. You heard me right, 5 to 10 years. And part of this is based on some work by Harry Dent and James Rickard. If you aren't familiar with these two individuals, they've written some excellent books. They take somewhat opposite views, but they basically come to the same conclusion, and that conclusion is basically we are screwed financially. Harry Dent is a deflationist. He believes that due to demographics, the baby boomers being the largest driver of the economy since the 50s are getting older. That's the age group I fit in. And yes, I'm over the big 60 years, and seen a lot of things happen in my lifetime, done a lot of trading, and I've learned a lot of things. I've probably made every mistake in the book, and hopefully I can save some of you, my audience out there, some heartache. Opposite Mr. Dent is Jim Rickard. Jim Rickard is more of an inflationist. He believes that the Fed is in a corner. They are going to do what they have been doing for the past 6 or 7 years since the financial crisis began in 2007, and that's to flood the market with money. So far to the tune of about 4.8 trillion, and that's just the stated amount. That doesn't include the derivatives, which is somewhere in the neighborhood of $500 trillion, and nobody's really sure how that's going to be unwound or who's holding the position. Right here I'm showing a monthly chart of the NASDAQ composite, and the reason I am using this particular chart is this is where all the action has been in the go-go stocks, and I'm talking about Facebook, Google, Amazon, and a few other names out there that have really been hot. The other one I was thinking of was Chipotle. Of course, all of these stocks have been hyped up by CNBC, Jim Cramer, just about everybody that's in the mainstream media that gets paid for basically keeping the equity market from going to code blue. So here we're looking at the composite index, and I'll be looking at the four stocks that I mentioned: Amazon, Chipotle, Facebook, and Apple and Google, 5 stocks. Here's the bottom of the market back in 2009 when we had the massive sell-off. In the Dow, we went from around 16,000 down to about 6,000. On the NASDAQ, we were up around 3,000 and went down to about 1,300. In real terms, it was actually lower than the crash of 2000, where we went from 5,000 to 1,000. So adjusted for inflation, the last crash in '07 through '09 actually left the composite in worse shape than it was before. But as you can see, it's been pretty much of a secular bull market for the past 5-6 years. Now we're up here at the top of the range. If you look at the relative strength index, which gives you basically overbought or oversold if it's over 70, it's overbought. If it's under 30, it's oversold. But these things, these overbought or oversold conditions can last a long, long time. And we've been overbought here since 9/1/13. And right now, this is about getting ready to roll over. As you can see, the what is called the MACD, or moving average convergence divergence, and the whole move is losing a lot of momentum. And we're looking for the monthly chart to break this parabolic, this dot right here, and which will probably take us down to this lower Bollinger Band before we get a significant bounce. So we're looking at probably about 1,000 points or 20% on the NASDAQ, and we could get a 50% bounce from that Bollinger Band back up to about 4,300. But let me tell you why I'm very concerned about the composite. Let's go to daily charts and let's start looking at some of these stocks. Amazon, look at this thing, this huge move we've had over the past few weeks. This first gap up was in April, and we moved from about 400 to 482. Looks like we put in a reversal here. Again, the RSI is turning down. Next one is Google. Same thing. Look at this huge move from 534 all the way up to 675. This is a huge gap area that definitely will be filled. So we can look at some serious downside action on that one. Let's look at Facebook. Same story. We were in the 80s, popped up almost to 100, and that was from the initial public offering. I believe it went public at around 60, if I'm not mistaken. And the last one is, or not the last one, the last one is Apple. Everybody's favorite. In fact, there's a note here. Even Kramer was saying, go ahead and buy Apple on this dip here. It's a very good purchasing place here. A good place to purchase the stock. No, this is a death trap, so you definitely don't want to do that. And finally, we have Chipotle Mexican Grill. And this stock has absolutely gone crazy. It's gone from 600, and this is a classic reversal up here from 600 to 733 in less than 10 trading days. So that's why I'm very bearish on the market. And if you look at these stocks that I mentioned on a monthly basis, you basically get the same characteristics, and I do believe that this market that has been really started in 1982 when it bottomed out a little below 800, and we've had these moves up over the past 30 years, and we really haven't had a protracted bear market, and I'm talking 10 to 15 years like we did in the 70s, but I'm afraid we're about ready to see it. So I'm out of time, folks. Good luck and good trading. This is Frank Black, the FedWatcher, and we'll be seeing you again soon.